Good afternoon, everyone. Once again, my name is Nyan Koto, and I want to welcome you back to the Common Sense Investment Platform. Look, I got a surprise for you guys at the end of this video. So if you never watched any of my video to the end, and if you're planning on leaving anything like a home or any form of investment to your children when you pass on, there is a law that is made for the rich in this country. You probably don't know about that law, and I will explain that at the very end of my video. So watch to the end. But before we get into discussing why the rich in the United States pay less taxes than the poor, let me just make it clear that I'm not a financial advisor. So if you're going to use any of the information in this video or any other video on this platform, please do your own research. To help with the discussion today, I went on IRS website, copied the tax bracket for long-term capital gain from the stock market and the tax bracket on income from just work. As you can see in this table, if you are filing single and your income is below $48,350, you only get to pay 0% tax on your income from your investment, like your dividends or any other distribution that you receive. And if you are filing with your husband or wife and your income is below $96,700, you pay 0% as well. Overall, the maximum tax rate you're going to pay on your income from your investment in the stock market is about 20%. But if you work, let's say you trade an hour for a dollar, you left your house, went out there and worked for somebody else, and you earn $11,925 and you are filing single, you pay 10% tax. If you are filing with your husband or your wife and your income is about $23,850, you get to pay 10% as well. Look at the difference. You get up and go to somebody's office or somebody's warehouse or anywhere, stay there whole day and work, and you bring home $11,925 a year. Because that money came from working, you will pay 10%. But if you sit down at home and sleep all day, and your investment in the stock market made you for the $8,000, you only get to pay 0%. This is why it is critical for us to invest. Because like I said in my previous video, the tax law in this country, they are made to benefit people who invest and start businesses than people who work and earn income. So when you are old, at that point where you are not able to work, if you have good build of money invested, your tax bracket will be very low, and that money will be working for you while you sleep. That is why it is absolutely critical for us to start investing now, so that when we are older, we have enough that we can live off of without worrying about money. That is what they call financial freedom. So now let's get back to the law made for the rich that I talked about in the beginning of the video. It is called the step-up in basis. So let's say if you bought a house for $100,000, and at the time of your death, that house is now worth $500,000. Your children can sell that house and pay no capital gain tax using this step-up-in basis law, because it allows the base cost of the home to roll up to the value of the home at the time of the death of the person. So if your children do not know this law, please tell them, especially if you are leaving anything like a house or any investment in the stock market. This law applies to everything. Thank you for watching, and continue coming by to watch more videos. Thank you.